Thank you, Professor. Thank you, Olivia. Good to talk to you all. My case study and research today is titled Private Retirement Systems and Sustainability, Insights from Australia, the United Kingdom, and the United States. And you know that PRI is an organisation that focuses on incorporating environmental, social, and corporate governance into investment practices. But after 15 years of working on this, we think there are other factors to consider when thinking about sustainability and retirement systems. And so connecting the financial system and the real economy requires the alignment of financial policy and regulation with sustainability objectives. And this includes the consideration of market structure. Now, we define retirement system sustainability as the ability of plan boards and managers to be responsible investors, active stewards and allocators of capital to economic activities with desirable social and environmental outcomes. We concentrate on private retirement systems in this research, which are among the largest pools of long-term capital globally. And the three selected countries, Australia, the US, and the UK, are those with the most total assets in these private systems. Now, by reviewing policy and structure, we aim to better understand the behavior of various actors, their key challenges, and how sustainably retirement systems can function overall. We identify three key structural challenges within these national retirement systems. The first is the issue of market fragmentation, which tends to undermine the responsible investment support and activities among retirement plans. The second is the increasing importance of fund managers and investment consultants, and their relatively limited responsible investment incentives. And finally, what we see is as the growth in personal pension systems, which lack emphasis on sustainability, reflecting the principal agent issues in these structures. Now, we studied policy frameworks and important structural variables such as fund concentration, number and type of actors, and relative market power. And in the research, we gathered data from various national pension and retirement authorities, consultants, think tanks, as well as investment industry organizations. We've reviewed the literature and we've made this paper available for you to consider. Now, what we found on the first issue, market fragmentation. So public sector retirement plans generally benefit more from economies of scale. Large asset owners generally have an increased interest in reducing market risk and externalities presented by sustainability challenges. And through diversified global and long-term portfolios, they can try to address some of these issues. Now, in its highest form, this is commonly referred to the idea of universal ownership. Now, these larger plans with greater asset under management also generally tend to have more market power. They have the ability to influence services and products in the market. They have stronger governance and in some cases, stronger internal investment expertise. From a system perspective, if we use membership of the PRI as a proxy, our findings suggest that when the number of asset owners with scale, with large scale in a system is low, the system-wide consideration of sustainability challenges is also low. Now, at the same time, we find that other segments of the retirement system with high fragmentation in terms of assets often showcase potential shortcomings, such as weak governance, insufficient investment expertise and resources, investment chain complexity, and principal agent issues. Overall, fragmented systems face the greatest challenges in developing sustainable investment practices. The second point, the role of service providers. Now, in our research, we showed that the weight of capital and influence of actors in private retirement systems has shifted away from institutional asset owners undertaking traditional investment strategy, asset allocation, and manager selection on behalf of beneficiaries. And it's moved towards financial service providers who have assigned responsibility to other individuals to determine their own investment approaches. And as a consequence, we find that most retirement plans rely heavily on the fund management and investment consulting industries in the formulation and execution of their investment strategies. And both industries are dominated by a relatively small number of firms with significant asset concentration, these service providers. And accordingly, while the market power and resources in theory could imply that they would be best situated to drive responsible investment and stewardship, in practice, there is a lack of incentives for these players, and that results in limited execution on responsible investment. And then finally, this area of principal agent conflicts. So we examine personal pension savings, the fastest growing segments of the 3 countries examined, and we looked specifically at around $12 trillion of assets under management. And here we found that individual savers are faced with complex choices that they are generally ill-equipped to make. And I noted the comment from the last session that we all expect they will, but generally they are still ill-equipped to make these complex decisions. And so they must rely on independent financial advisors. And in these dealings with financial advisors, cost is a far more comprehensible metric than value or quality. And as a result, cost is usually the focus for these individuals, investors. And for this reason, sustainability is often not considered, despite the increasing interest of these individual investors in sustainability. We also find that data in personal pension markets is insufficient to draw a complete picture in terms of market share and product uptake on these sustainability-oriented options. Now, while the general lack of transparency limits the insights we generate on firms and products in this research, we conclude that the structural challenges and lack of market focus hinder sustainability in this large and growing market. And so to conclude, we identified three key structural challenges within national retirement systems, which include market fragmentation, principal agent conflicts in personal pensions, and the role of service providers with limited incentives. Now, regulators in many parts of the world seek more sophisticated policies to align the financial system and economies with sustainability objectives. And this is all important work, but we should not overlook the need to devote equal attention to retirement system structure. The results provide insight into how or whether retirement systems can, in fact, facilitate desirable economic, social, and environmental outcomes. And as a group focused on ESG incorporation in practices for so long, we believe that this area of work on system structure is an essential next step. Thank you, Professor. Back to you.